Greetings to all our IMAPS clients and investors. Let me walk you through the latest changes made during the first week of July. 2026 continued to be a year of expansion with major markets showing meaningful positive returns. While the investment backdrop remains constructive, it is becoming increasingly dependent on key countries, central banks, and stakeholders to take adequate fiscal, monetary, and geopolitical measures. The Middle East remains dangerous, and the Strait of Hormuz remains strategically critical. But markets have moved from panic to pricing, allowing risk assets to recover. At the same time, the US macro backdrop is benign and improving, with recession risk for the balance of 2026 reduced to 15%. As labor market remains resilient, credit conditions stay stable, risk appetite recovers, and AI-related capital spending contributes meaningfully to nominal growth. We remain constructive on equities, and increasing S&P 500 year-end target to 7,800, reflecting a stronger earnings momentum, record-level margins, and better macro conditions, while recognizing that much of the easy geopolitical rebound has already taken place. Valuations are elevated. However, today's market leaders generate substantial earnings, free cash flow, and margin expansion, with recent returns driven more by earning growth than multiple expansion. AI has become a macro variable rather than just a technological theme. The AI build-out is fundamentally a physical investment cycle in which the key bottlenecks are power availability, transformers, switchgear, land, labor, interconnection timelines, and electricity demand, making scarce infrastructure owners and suppliers potential winners. The positioning of our portfolios continues to be risk-on with a tactical tilt towards equities. Nevertheless, the fixed income portion of all our portfolios maintains a core allocation to investment grade to ensure that they are well positioned to navigate market volatility. The goal is to manage risk-adjusted performance by following a prudent approach. The biggest near-term risk is a Fed policy mistake, particularly if supply-driven inflation from oil, electricity, housing scarcity, and infrastructure bottlenecks is misread as excessive demand. The biggest long-term risk is political backlash, as AI and space create enormous wealth, while many households continue to face affordability pressures in housing, insurance, healthcare, education, and utilities, raising the risk of higher taxes, new levies, and regulatory overreach. The potential sources of volatility for the rest of the year rest with the Fed policy, midterm US elections, and another round of increasing hostilities between the US and Iran, as well as market concentration in tech hardware stocks. Interest rates have trended up during the first half of 2026, negatively affecting the performance of fixed income instruments. While the portfolio has remained resilient, the macro picture has not favored the asset class. Portfolio duration was kept in the 5.5-year range, which we consider is the part of the yield curve that offers the best reward per unit of risk. In our view, security and manager selection remain adequate, with managers behaving well in their respective spaces. As a result, we have kept the portfolio and manager positioning constant. Income generation is our key performance pillar, while emphasizing high credit quality. Bottom-up credit selection and low correlation remain the main sources of alpha generation for the portfolio. High yield and emerging markets have delivered positive returns, even when confronted with growing geopolitical and credit risk, supporting our diversification thesis. Equity exposure stayed unchanged, in line with our positive outlook for equities in 2026. Nevertheless, our investment thesis assumes a persistent level of above-average volatility. The market-neutral equity strategy introduced in the previous quarter has worked well to mitigate volatility by reducing equity correlation while providing positive returns. We hope you are well, and as always, please reach out to your financial advisor or investment professional with any questions you may have. Thank you.